I have a series called 2 Undervalued Stocks to Consider. I do this video every month and I'm trying something out, and this series is called The Best Buying Opportunities in the Stock Market Right Now. Not stocks that are close to fairly valued, not stocks that could be undervalued in the future, stocks that are undervalued at this exact moment. That if I didn't own any stocks and I just had some cash around, I had to choose 3 or 4 stocks to buy. Which stocks would I choose? This is what I'm going to talk about in today's video. If you enjoy these kind of videos, all I ask, if you could please press the like button and let me know what you think in the comments, if you enjoy them or not. Without wasting your time, I'm going to get into the first video. Some of these stocks, I talked about them before, most of them, but I believe they are the best buying opportunities at this second. And the first one is Ulta Beauty, down 21.5% year to date. Most of the retailers have been suffering, not just Ulta Beauty, Lululemon, which a lot of you guys like that stock. You told me in the comments. It's down 36% on the year. Another retailer I talked about last year, I said the next Costco, which is a similar business model as BJ's, but this one's up 19.5%. And what that would tell me is that investors are really concerned about recessions, because stocks like BJ's and even Target has been holding up, Walmart has been holding up. So the stocks that are necessity are really holding up or going up. But stocks that are more cyclical, so maybe makeup, people believe it's cyclical, maybe some other consumer discretionary retailer, they have been crashing like never before. And this is because a lot of people are expecting some kind of recession to happen this year or next year, or an economic slowdown, which would mean these companies will most likely have to revise guidance. And this is why Ulta Beauty has been crashing. And someone on Twitter commented something pretty interesting, and this is how Ulta Beauty performed in the 2008-2009 financial crisis. Earnings per share went from 25.54 to 25.34 to 25.27. I mean, not net income per share, but that was net income in total, which was almost nothing. It barely went down 2 or 3%. And in 2010, it grew from 25.27 to 39.36. So Ulta Beauty did amazingly well in the 2008-2009 financial crisis, because women were still buying beauty stuff. They were still buying makeup. People still want to take care of themselves. They want to buy things from Ulta Beauty. So even in the financial crisis, Ulta Beauty held up amazingly well. Even in 2022, when people were calling for recession, Ulta Beauty stock went down. Earnings suffered a little bit, but they still grew in EPS, and they still did amazingly well. And I believe this year is going to be the same. But for a lot of analysts, they try to compare year on year. So they compare 2024 to 2023, and it's not going to be the best comparison, which is one of the reasons why the stock is going down. But the market believes we're going to have a recession. Ulta Beauty is going to lower guidance. And this may be true. But what happened last year, whenever I was talking about Ulta Beauty, now it's sitting at the same price. This is when I was talking about it last year. And people were saying they want to downgrade guidance. It's the same exact thesis. But because Ulta Beauty bought back so much stock, they actually raised earnings per share guidance. And this is what started the move to the upside. And Ulta went from $380 per share, where it's trading right now, to pretty close to like $560 per share. It went up 48% in 4 or 5 months. Just whenever people, they just did not lower guidance, even raise guidance, because they bought back so much stock. And this is a chart of the shares outstanding. Ulta does buy back so much stock, and they most likely have been doing it right now, because the company has $766 million of cash, around $200 million of free cash flow every quarter, and no debt. Of course they're buying back stock. And for me, of course, they're going to raise earnings per share guidance, and that will likely surprise a lot of people that are expecting an earnings downgrade or a downward revision in guidance. And if we do have the downward revision in guidance, I would argue it's most likely priced in. But if it's not priced in, we might have one more dip before the whole sentiment changes and Ulta Beauty goes up. So this is why I really like the stock over here. I think the bottom is near. We might have one more dip. But to me, I'm fine with it. I really like it at this price, and I would love to average down if the stock goes down. It's trading at 14.5 times earnings, one of the lowest it traded at since 2014. The mean was 26 times earnings, now sitting at 14.5. So you're buying it well below the mean. And the way I think about Ulta Beauty, now the free cash flow yield is 6.5% on this no debt company, which is good. So you're getting 6.5% free cash flow yield, which they have no dividend and they used to 100% buy back stock, do some other investments. But we're getting to 6.5% free cash flow yield. Ulta Beauty has been growing earnings per share, sometimes 30%, sometimes 8%, sometimes 5%. But I would say on average, they will most likely be able to grow it around 8%. This year is going to be the worst. 2025 is fiscal year 2024, which you could say 2024 in general. It's sitting at 2%. This is the expectations. But next year is likely going to rebound to 10% because it's all year-on-year stuff. Then 11.4%, 16%, and 12%. Now, I don't care about any of that stuff. As long as Ulta Beauty is growing 6% in revenue, 6% free cash flow yield, I would say 12 to 13% annual return, excluding a multiple expansion, if the stock goes back to 20 times earnings. This is where it was trading at. It bottomed exactly at this price last year, around 14 times earnings, and it topped around 20 times earnings. And it all happened within a few months, like 5 or 6 months. The stock went up 48% because it was selling off for no reason. We still don't know how earnings is going to look like, but just because investors are expecting a downward revision in guidance. So because it's expected, I would argue it's priced in. And I would argue if we have the opposite and Ulta Beauty raises earnings per share guidance because they bought back so much stock, this could mark an amazing bottom on the stock. And I would argue we could most likely have a repeat of what happened last year of around a 48% gain in 5 or 6 months. That's what I'm expecting on Ulta Beauty. Having no debt, having a good balance sheet, they are well positioned to weather the storm. And I don't think makeup is as cyclical as people believe. If they buy cheaper makeup, they could still buy it from Ulta Beauty. They don't have to go anywhere else. So I like what I'm saying. I think the stock is undervalued. And if I didn't have any stock, all I had is cash, I would be buying Ulta Beauty at this price. Now, this is the second stock I'm going to talk about, which is more of a smaller cap. I talked about it in my video last week called 2 stocks I own with very high upside potential. And this stock is BDT Bird Construction. And I'm talking about it because they reported earnings. After they reported earnings, the stock skyrocketed like 10 or 12%. And it came back down. And this is why I'm seeing an opportunity in Bird Construction, because earnings were absolutely stunning. But if you're not familiar with the stock, also I would encourage you to watch my video, but if you're not familiar with it, it's basically a construction company in Canada, but they do many different things from manufacturing, nuclear energy, long-term contracts, wind, trying to transition Canada to carbon neutral, a lot of their different companies and infrastructure stuff, a lot of updating, rail, mining, education, data center, power, oil and gas stuff. I said about nuclear. So they do many different things within the energy sector and just construction and commercial buildings in general. And last earnings, which was reported a week or 2 ago, was absolutely mind-blowing because revenue grew 28%, net income grew 93%, earnings per share grew 100%. 100% earnings for a company that's trading around 11 times earnings. When I first talked about it, it was at 8 times. Now it's trading at 11 times, and it grew earnings 100%. Now, whenever a company grows in earnings 100%, and it was growing 54% last year, the first thing people would expect is that this is not sustainable because construction is cyclical and there's no way they can sustain it. And this is the main risk with the company. But the company has a backlog, and they grew the backlog again this quarter, but the backlog in total grew around 20% year on year. And they have $1 billion in recurring revenue contracts. These are in revenue streams they will most likely get every single year. And if you heard the earnings call, the CEO said that because of what they saw with the backlog and what they're saying so far in 2024, they expect the current growth to last pretty close to late 2025 to early 2026. So I'm not saying every single quarter Bird is going to grow 100% in earnings per share. But if they grow even 20 or 30% earnings per share and the company is trading at 10 times earnings, this is massive upside potential on the stock. And the stock skyrocketed on this news, but then it came back down. And this is why I'm seeing an opportunity. Now, the main reason it did not sustain those gains is because the stock is up so much this year. It was up like 40% going into the report. Now it's up 49%. This is a stock that I own in my personal portfolio, and I share what I do in my own group. The link is in the description. But I'm still seeing an opportunity with the stock. People shy away from it because it's trading at all-time high or trading at 52-week high. And to me, this is the worst argument I've ever heard. I mean, imagine skipping Apple or Google in 2014 because they were trading at all-time high, even though they were undervalued. And as Warren Buffett says, price is what you pay, value is what you get. I don't care about the price. I care about the value. Bird Construction is still offering value at this price. I think it will most likely be making new 52-week highs over the next few months. And I still own the stock. If I had some money, I didn't have any stocks, or I didn't own anything else, I would be buying Bird Construction, betting 20-30% earnings per share growth, and they have like a 5% dividend, 5.5% dividend that they pay out every single month, I believe. And you could also have a potential multiple expansion. Now it's trading at 10 times. The mean was 13, and it traded as high as 26. And the main reason for everything that's happening within earnings is the margin expansion. The margin right now is around 3.6%. And the analyst asked him on the earnings call that in 2010, he was able to get his margins to 9%. And he asked him, can you do it again? And the CEO said, this is what they're trying to do, and they could do it again. So imagine you have revenue growth of 20-25%, margin expansion from 3% to 5-6%, or even 9% if you get it there, and a 5% dividend, 6% free cash flow yield. Just amazing stuff with a good backlog. So if I didn't have any cash, I would definitely be buying Bird Construction. The third stock that I would buy if I didn't own any stock would be PayPal. PayPal right now is down 41.5% over the last 5 years. Most of you know the company, so I'm going to keep this one very, very short. PayPal, to me, the way I look at it, just same thing I shared in my last video, free cash flow, they expect it to be $5 billion. Most of you know PayPal has a stock-based compensation expense, very high stock-based compensation of around $1.5 billion. That would leave them with around $3.5 billion in real free cash flow. So a free cash flow yield, I made the calculations, would be around 5.5%. So we're getting a 5.5% free cash flow yield, and revenue has been around 7 to 8%. Now, I would expect PayPal to grow around 7 to 8% for the next few years to come. I would not expect PayPal to get back to 15, 20, 25% revenue growth. I think that's extremely unlikely because the company has most likely matured. Unless they come up with some amazing products that no one was expecting and it brings growth to the company, I'm not expecting anything above 7%. So if I'm getting, let's say, 8% revenue growth, and we're getting 5% in terms of yield, free cash flow yield, in my opinion, the annual return would be pretty close to 13 to 14% annual return. So around 13% annual return, and I'm not really expecting any multiple expansion. But if we do get a multiple expansion, if the growth pick up, we get a multiple expansion from 15 times, I'm not saying to 30 times, but maybe to 18 or 20 times. This could be an extra return on PayPal. So to me, PayPal is a no-brainer at this price. It's a hated company with bad sentiment. I still like it over here. I don't own the stock. I've been selling put options. I shared it with you. Whenever it was going down, I sold $50, $55 puts, never got assigned, collected a nice yield. I would most likely do it again. That's what I've been doing with PayPal. But if I didn't have any stocks, I would be buying PayPal over here, and I would be expecting 13 to 14% annual return, excluding a multiple expansion, which would end up being an amazing return on PayPal. Now, the last stock I would buy, and this would be my smallest position, because it's the riskiest one. It's even riskier than Bird Construction. A lot of you think Bird is risky because it's small, and I agree. Normally, I keep a very small position in such market caps, like 1, 2, 3% normally of my portfolio. But for BMY, which I think is the last stock I would buy, it's the riskiest one, but it has the highest reward. And to me, this is the most misunderstood stock in the market. And even as much as I could claim to understand it, no one can really understand pharmas as much as the expert could do, but I do my best to understand it. And I was debating between buying Pfizer and Bristol Myers, if you remember, and I ended up buying Pfizer because Pfizer has the best backlog, or the best pipeline, I should say. But for Bristol Myers, it is down 19.5% year to date, pretty close to 20%. If you look at the earnings, it says earnings were down, or net income was down 626%. Earnings per share was down 650%. This is not true. It's a big confusion that a lot of people have. And all that stuff was mainly due to one-time expenses. The guidance was supposed to be between 710 to 740, but they had acquisition, and the acquisition impact is $6.30. But then they had some dilution impact, which I'm not going to count. So the total impact of the dilution and the acquisitions was $673, which are one-time expenses. It's not really in terms of the business, one-time expense, $673. So they had to revise their earnings per share guidance to 40 cents to 70 cents. and it freaked out the market from $7.10 to 40 cents. This is a massive, massive downgrade in guidance. But in terms of the real performance of the business, you really have to take out around 40 cents, which is dilution. Because this acquisition expense, it's a one-time expense, and it's not going to happen every single year. So if I take out the 40 cents, if you want to take out from 740, it will most likely make up around $7 per year of adjusted earnings per share, which is what I would use. Now, $7 per year in EPS is around 6 times earnings. So you have Bristol Myers, which is a company that a lot of you are familiar with, is trading at 6 times earnings. This is very, very low. And the reason it's trading at 6 times earnings is because they have a lot of their legacy products, like Eliquis, which a lot of you know. It's expiring, I believe, in 2026. They have other legacy drugs expiring in 2027, 2028. So a lot of the legacy drugs are expiring very soon. And Bristol Myers invested some cash, took on some debt to invest in the growth portfolio, which you supposedly will eventually replace the legacy portfolio. And this is what Bristol Myers is planning to do. This is what most pharmaceuticals plan to do. But pharmaceuticals like Pfizer and others, they have a very strong pipeline, and Bristol Myers doesn't really have this strong pipeline. So they really have to rely on acquisitions, and that's why the stock trades at 6 times earnings. But 6 times earnings, the growth portfolio has been growing. It's not the highest growth ever, but it's on the right track, from 4.4 billion to 4.8 billion. The legacy portfolio is still growing from 6.9 to 7.1. And I believe the expectation is by 2029 or 2030, the growth portfolio is going to replace the legacy portfolio. But from now till then, Bristol Myers have done a lot of acquisitions, and one of the main reasons it's been trading so low is because of the balance sheet. The net debt is 45 billion. Now people look at that stuff, they say, oh, 45 billion, that's a lot of net debt. I would never touch the stock. But I don't let that stop me. I would look if Bristol Myers can actually repay the debt. And for free cash flow, it's expected to pretty much be the same, around 12.6 billion in 2023, 14 in 2024, and then it declines. So it's pretty much around flat. So it's not expected to grow in free cash flow, not expected to decline. The new acquisition is expected to offset the old acquisition, and it's been happening in real time. So I'm not seeing growth in free cash flow, but the free cash flow will most likely end up being the same. So if you take the $14 billion, which is the guidance from the company, and I believe it's fair, $14 billion, their dividend expense is $4.7 billion. You could count it as $5 billion in dividends. So $5 billion in dividends and the $14 billion in free cash flow. This is pretty close to $9 billion. So they have $9 billion every single year. So you could say 8 or 9, but let's say $9 billion every single year for them to repay the $45 billion of debt. They could repay the debt. They could use it to do more acquisitions, which is going to grow even more. And it's going to even be better for them to replace the legacy products, or they could do acquisitions, as I said, or they could repay the debt, or they could even buy back stock at such low prices. And this is what Bristol Myers has been doing. They have a good buyback program, and they've been buying back a lot of shares, and I think they will continue to buy back a lot of shares. And for the dividend, it's trading at 5.7%, and the payout ratio is less than 50%, and the free cash flow is sustainable. So I would say the 5.7% dividend, or pretty close to 6%, is sustainable for a lot of dividend investors that are looking for dividend income. But the way I look at Bristol Myers, the new drugs will replace the old drugs. The company has enough free cash flow, $9 billion a year, times 5, that's $45 billion over the next 5 years for them to repay the $45 billion of debt, save on interest expense, or to do more acquisitions, or to buy back stock. So I'm not seeing how Bristol Myers is not going to replace the legacy portfolio with the growth portfolio. But the market is freaking out because there's uncertainty. It hates uncertainty. It believes that the legacy or the growth portfolio is not growing as fast as it should. But the company could still get another $45 billion of cash over the next 5 years and do more acquisitions or whatever. But Bristol Myers right now is trading at 16% free cash flow yield. And we talked about the free cash flow not growing or declining. So if nothing happens, it trades at 6 times earnings, no multiple expansion, although unlikely. I would expect on the minimum 16% return annual. On the maximum with a multiple expansion, could be 20 to 25% or something crazy like 30 or 40% return within a few months. if Bristol Myers reports something good on the next earnings report and the sentiment changes, this is normally what happens with these stocks. And there's a lot of bad sentiment with Bristol Myers, but it's definitely the riskiest stock between all of them. I would say the safest one is Ulta Beauty for me, then PayPal, then Bird Construction, then BMY, Bristol Myers. This is how I would put them. And this was my opinion on the 4 best buying opportunities in the stock market, not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another